Good morning, ladies and gentlemen. Well, it was an interesting week. I thought that at the close of the week that the direction had been set, but once I'd re-looked at all the charts and all the spreads, I think this is going to be a very, very tough and whippy week ahead. Uh, let's review what happens, and I'll tell you why I'm thinking that it's going to be a whippy week. We closed back at 86, slightly lower if we look, all the prices are here. On Thursday, we closed at the lowest level that we closed for many weeks, down at 73, and that is primarily due to the volatility triggers which reset on Friday as volatility came down. It's basically a mess. And while I don't doubt, and I will show you later why I don't doubt that we are in a corrective phase in the assets, whereby I've been saying for weeks and weeks that we are equities first, followed by gold, followed by bonds last, that we could be now in a middling phase where basically you get readjustments between the bonds being the worst. The bonds might be the best for a few days and then back to worst. It's going to be one of those things that is designed to make you tear your hair out, which is always the case. But if you look at the longer term trends, it's going to take a lot to turn this super tanker around, and therefore, just because we have a week or two of no direction overall, but spread readjustment, which I will show you, that does not mean that we are anywhere near risk off. If you want to keep it really, really simple, I think deviations is going to sum it up best for you. I keep on repeating you should download this daily. Here we are now at the center line. Just going up and down is probably favorite here, simply because if you have a look at what the individual sectors are doing, you will see that the favorites so far, which have been XLE, XLF and XLI, they got so overbought and basically they're coming out of the red. Would you be surprised to get a retracement back to XLE to these kind of levels? Absolutely not. And the same is true for XLF and XLI, which basically means rotation back out of the things that have been favorite up to now, and some sort of a bounce in the things that have been sold like crazy, like XLU. Would it be surprising to see XLU come out of the green? Absolutely not. That all says that bonds are bouncing, and therefore the big trends, which we'll show you later in the spread assets, are just going to retrace. What does that do to things like XLK and SPY? Well, it keeps them stable. It keeps them whippy, but actually overall stable as a level. And we shall look at all that in detail later. But that is what it looks like. A week of, whatever you do, you're wrong, and then you're right. That kind of a week, trendless, but overall a readjustment in the SPY and TLT relationship, which was in such strong trend, and we will have a look at that in detail later. Having said that, the overriding danger in this market is one of repricing. We will have a look at TLT later, we'll have a look at what that is saying, but to me the danger is always in the background that we reprice to a level around the 20 to 21 area of forward earnings. I've shown you the maths many times. That would indicate somewhere around the 3700-ish area. That is what the fundamentals are saying, and really it wouldn't be surprising if we couple these two views over the course of the next 2 to 3 months, have a market which trades between 3,900 and 3,700. That is how the fundamentals and the technicals are coming together. These will slowly come up as the usual analysts race each other to outcompete on the upside, which is always rubbish because we never achieve the $180 of forward earnings that they're expecting. But that doesn't mean the market doesn't listen to it. I really wouldn't be surprised by a bit of repricing, but really I think that the next week is going to be particularly difficult, and it's more likely to happen at the back end of March that we get a stronger move lower. But one step at a time, I will go into it in detail very soon. What happened in Bondland? Well, last week we saw absolutely the biggest moves we've seen in the yield curve since a long time ago. I would say since 2013 or something like that. So what happened? We had a massive steepening and then a reaction lower. This is the 2s10s, as you can see, and we closed it right on top of the levels that are resistance, 126, 127 basis points. What is likely to happen? I think what is likely to happen is exactly what happened in these months back in 2016, 2017, is that we now slowly trade back towards this 110 level. This level of steepening is unsustainable for many reasons, because a lot of people can now, through the FX market, start arbitraging the curves, and that is going to provide stability. Also, never forget that the Fed is looking at the same charts that I'm looking at. They have very good professionals who understand the yield curve very well at the Fed, and they know exactly where the trigger points are, and they know what those trigger points mean for assets, just like I do, and they will do their utmost to keep this market with some semblance of stability. If we start closing the week above these levels that we saw around the 138 level, I really don't know what is going on anymore, and I think it's just a loss of control. I find it very difficult to believe that the Fed is going to lose control this quickly. So I have to give them the benefit of the doubt, and I have to think that the direction that the market wants to take it in, and that the Fed would like the market to take it in, is down towards this 109, 110 area. Every part of the yield curve moved very violently. 5s, 10s, this is a weekly chart. We had a weekly move of, from, let's call it 79 down to 68. So that's 11 points on the week, but in the meantime we were down here. So that is a very pronounced move. Basically, it's just saying that these levels that I have are very important. Within 1 or 2 basis points, they are triggers, and everyone knows it. I mean, not everyone, but the professionals know it, and they will try to do their best to return this towards, let's call it 60 basis points. It just makes sense to me that it's not going to be that easy. The steepening cannot continue because it's just so easy to arbitrage it through FX. Now, if we have a look at what happened in 530s, which to me was, the most important one, straight back down to here, and now would I be surprised to see a, continuation of something around this period of time? Absolutely not. It goes into the low 130s, back to 140, into the 130s, back to 140. That would be the least surprising thing to me. A period such as this would be really what the doctor ordered. This is a daily chart of 10 years, 30 years, and you can see how violent the moves have been. I mean, I wish I hadn't done anything at all with my position. I've been trading this like a banshee all week, and really I would have made twice as much money had I done absolutely nothing. To me, 10s, 30s is just too steep. It is the part of the curve that is just too steep. I really would not be surprised to see a range trade here between 80 basis points and 65 basis points. Again, this is very similar to my expectations for 5s 30s and for 5s 10s. Really one where the longer end finally stabilizes, and we can actually now see the reasons why it is likely to do it and why it should do it. And here we have the longer end of the curve. Have a look at what happened to the yields in the 30s. They touch beautifully the 237 basis points level here, and formed a hammer, a hanging man, and now down on Friday in the last hour as people rebalanced, as the big pension funds rebalanced. Can we give some of that back? Of course we can. That was just a very ridiculous move in the last hour of trading. Everybody bought bonds, everybody sold equities. Equities will bounce and bond yields will bounce too. But I think what that has done for the week, you will see. Have a look at this huge hammer in TLT. We touched to the tick the 136.99 level, and boom, we bounce. Where do we bounce to over the course of the week or the next 2 weeks? I think the odds of us breaking 148.90 on the upside now are very low. But I think that we travel overall in that direction over the course of the next week or two. Basically, what we are doing is we are correcting the steepness of this, the ridiculous steepness of this move. Where do we get to? Well, probably around the 2 level, between 2 and 190, this kind of area. Exactly where we should be on TLT, around the 148.90, and then we can probably, after a few weeks, retest down towards the 137 level. Basically, my longer term view is that we're doing something similar to here, i.e. we're now in a 137 to 148.90 range, and we play the range. What does the range in bonds mean? It means most probably a slow flattening of the yield curve. Nothing dramatic. I showed you the levels. And also it means that the sectors which have been pressured most by the steepening of the curve, and that is the high beta and the tech, can now probably have a respite and a brief period of outperformance against the things that have been hugely in fashion, and those have been energy, financials and industrials. What is going on in Europe? Well, just like in the States, the yield curve was steepening. This is now the bubble, the 5-year, and you can see how it's been steepening not very much. I mean, we couldn't even get to minus 48 basis points. This is now likely to come down to at least minus 61. But I think the next trade for us is beginning to right itself. I think that when we get down to this area and slightly below the minus 61, we have to start getting shorter futures. It's unlikely to go much through there. And if we have a look at the Bund, and this is now the Bund, I think the Bund is now going to come back down to these kind of levels, minus 38, minus 39, try to fill this gap, probably not succeed, and then move up. So it's very much the same kind of pattern as we are having in the bonds, but much less pronounced because Europe is much more insulated. There's much less issuance in Germany. And also we have a much more vigilant central bank. But you know, it's confirming my view in the of the States. I think we now come back down to this level around minus 38, and back to the 5-year, to the bubble. We are looking to trade to at least these levels down here, minus 61, minus 62. I'm really rather tired of talking about the dollar. I still think that we are doing nothing for the first quarter. The Fed wants the dollar cheap, because that will encourage people to buy US bonds without asking a ridiculous give up on the yield side. Could it do a little ABC that you can see better here on the dailies? And I will now try and... Oh dear me, how is this thing working? No, it's not. Let's go backwards. I'm sorry about this. It's a real pain in the arse. I will try it once more. I apologize. Right, now I think you can see it better here. A little ABC would target somewhere around between the 92 and 93 area, probably around this 92.56, and slap bang into the descending 200-day moving average. I think that is probably the likeliest thing. And how does this tie in with the bonds? It ties in so that the foreign central banks come in, and foreign players in general, but central banks mostly, they come in, they buy dollars and they buy bonds. And I think that is the thing that makes the most sense to me, is that we go and test, you know, we take out this level of around, what is it, 91.55, 91.60 in the Dixie, and we go up to, let's call it 92.56. Well, that is, you know, 2%. I suppose it's worth playing, but overall my view has not changed. All the danger in the dollar at some stage is lower, and really it's a technical play for 92.56. Gold, father-in-law's favorite, most voted to do nothing interesting over the next couple of weeks. You know, it's the second derivative of the dollars and the bonds. Now the bonds, I think, are going to do better. And unfortunately, I think the dollar's going to do better. So gold is going to get caught in between. It's going to get pulled by the dollar, or rather pushed down by the dollar and pulled up by the yields. So what can we expect? Well, we can expect some retracement from this very oversold level. We nearly touched 1710 on Friday, which was my initial bounce level. What was the low? 1714. You know, it's now going to go up to 1810, 1820, that kind of area, and then fall back down as the bonds fall back down in 2-3 weeks' time. I think this daily chart really explains it best. You know, while the 200-day moving average is still turning slowly, we go back and we stop everybody who sold below 1764 again, we go up to 1800, 1810, 1820, whatever, and then we smack back down to my eventual 1658. I think the first move in bond in gold is likely to be up, and then in a couple of weeks down, I have no doubt that we see my 1658. It's a trading asset. Trade it, don't position it. Now, one of the big reasons for my caution last week, warranted caution, was the steepness of the ascent of the ITOT government charts, whether you look at the weekly on this side or the daily on this side. I assure you that SPY IEF and SPY TLT look very much the same, with the differences being nothing to write home about. What would I like to see? I would like to see, as the bonds do slightly better, a little bit of risk off and a touch of this moving average, much like we did here. Quick A, B, C, down, boom, boom. Which basically since I know where my TLT cap is, it also gives me my SPY bottom. So really what I will show you where those levels come in through the mathematics that I've done, and really gives me a fairly boring week ahead in equities. Most of the moves should actually be in sector rotation, which keeps the averages themselves within fairly tight ranges of about 2%. So now this is my favorite 195-minute chart of the INX, and really what it's saying, when I do the mathematics of the ITOT iGov, is that the range is more or less between 37.75, 76 in the INX up to the 38.93 level. That basically the market is going to be contained through there all week. The outlier is that we could fall down to 37.25, but the maths really gets very, very unlikely that we even get to 37.25, and certainly very unlikely below 37.25. That's what the maths is saying. I have absolutely no reason to doubt it, given my view for TLT. A lot of the sectors are going to like TLT rallying overall over the course of the week. The tech should like it. We are going basically down this very slowly, going down, descending Bollinger Band. We are very slowly turning the moving averages, indicating a lot of resistance between the area of 38.93 and 38.61. It would take a lot to get us above this 38.93. I really don't know what would do that over the course of the next week or so. So the path of least resistance is stop everyone out, go back down, stop everyone out, go back down, in a very boring pattern, much like this one. I really don't think that we see below 37.25 and probably not below 37.76 over the course of the next week. If we do that, if we have a look at what the dailies are saying, well, the daily Bollinger Bands here are coming in at 37.55 and ascending, so that would really say that we are unlikely to go much lower, certainly in the early part of the week, than the levels I just showed you in the previous chart. If I change this to a weekly view, I really haven't changed my mind at all. 37.11 is going to be very good support. This moving average is coming up quite fast. It's going to be there within a couple of weeks. It just seems to me that we are very unlikely to trade below 37.25, 37.10. it just seems to be very unlikely given what I expect SPY TLT to do, and given what the technicals look in all the time periods that I can see in SPY and what the mathematics says that SPY can get to. The risk is always the repricing down towards 3700, but I think that the risk is quite muted next week. And this is why I think the risk is muted, because just as I thought that the NQ and the tech sector in general would have a very tough time last week, I think that it's going to be very hard for them to have a very tough time this week. We've kept on bouncing at the 50%, 0.382 retracement level around the 12,764. We just could not break through it. We have natural support at 12,786, and really the really big support is here, 12,440, call it. I find it very hard to believe that we have the 200 period moving average also just above it. So I find it very hard to believe that we will break 12,440 on a weekly closing level, and we are more likely than not to also trade this 13,400 area. And maybe fill this gap here. Let's see if I can enlarge this area. Where's the gap? Well, the gap comes up to 12,520. This is a very 12,530, very good levels to probably sell up there. So, given that I think that we have a better week in NQ than a lot of people can imagine, it's very tough for me to see that XLF will come back that far and pressure SPY. So I think that I'm probably being realistic when I say that the range in SPY is, a 37.75 as the bottom and 38.90 as the top. Just like I think I'm being realistic that I say that the best we can do is fill this gap here to around 12,550, and the absolute worst we can do is go down to the 12,400, 12,500 area on this chart. Maybe tag this moving average and then go straight back up. I think NQ is not going to have a very bad week. If we look at the tech spreads, that's basically exactly as what they're saying. We bounced off the 200 period moving average in this. This is Qs against SPY, but it's exactly the same in the other in the NQ against SPY. We are more likely than not to go sideways. We reached the target that I wanted and even lower. All I wanted was 83 and I got it. These levels, you can see how many times they've traded, this whole time. This is a long period since July, basically. And it just shows you tech has really not outperformed the market for such a long time, simply because we had the rotation out of tech into XLF as the whole yield curve was steepening. And now if we think a little bit of relief on that front, would it be really a ridiculous thing to think that we go back to 84? No, it would not. That gives you a slightly better week for NQ than for SPY, and then since that's such a large component, it basically tends to stabilize everything. The EM situation is exactly as I thought it would develop. Basically, we have a little bit of retracement against everything, and especially against Europe. Europe is now going to be a little bit of a safe haven as a little bit of dollar strength knocks back the EM spread against SPY, but it's not very far from bottoming. This kind of area around 13 and a half, something like 13 and a half, 13. That's where I want to sit. And if we have a look at what that implies for the outright in EM, I think it comes into here and stops people off. It stops and stops all the people who are long around, these levels. We've come up far too fast. It's to me, it's really a likely level to stop is around here. It matches very well, 52.08. That's what I'm looking, anywhere between 52.08 and 50.23. That also indicates to me that the downside, if the downside here is in the order of what's this? We close 53 and we go down to 50. So if it's like 2-3%, the downside in EM, like call it 4. We're really unlikely to have much more than 2% in SPY. So that gives you your parameters. I also wanted to mention one potentially interesting trade, longer term rather than shorter term, and I know that some of you are talking about it and looking at it, and that's the ARK fund, ARKK. This is a chart of it against QQQ, which is probably what one can compare it to. What would I expect it to retrace to if it's going to retrace? Well, I would expect it to retrace to this area, the 0.23 to 0.382 area, and you can see what the levels are there. It's between 327 and 285. If all you're looking for is for it to move down to 285, I've done the maths. That takes it down to around 105. So let's have a look at what that would be like. And here we have the 300-minute chart of ARK. It really wouldn't surprise me next week to see it rally to around this. What's this? 130 something area, 140 something area. It really wouldn't surprise me to see it above 143, 144, and that is, I think, the ideal area to buy puts against it. It matches with my view that for the first part of next week, or for at least a week or so, we have a better outcome for the high beta stocks because of the flattening of the curve overall. I think that would become an interesting place, say 146, to really get involved in ARK against QQQ. Finally, my great friend volatility, where I make the most money. What is likely to happen? We are likely to have a consolidation week. This is a daily chart and this is a weekly chart. We touched precisely 3106, and we are really likely to trade between 2250 and call it, 30. And I don't think we go back up very much. It's not I think we are more likely to have a compressed range between the, around this kind of area, was that 23 and a half, and these highs here around 29 and a half. I think we're more likely to compress than expand next week. I really don't see it as a very volatile week at all next week. Finally, on to the trade recap sheet. Here we are. These are the levels that I think things could trade and things that could be interesting. I've included Amazon and Apple. In the early part of next week, I think the boring stocks within tech, the ones that basically trade as a bond, should do slightly better than XLF, but you should know that what you're really trading is bonds. So these are all the levels. I've mentioned every single one of them. I will post this sheet as always, and please print it and please have a look at it. I'm very pleased, by the way, TLT bounce off the 136.99 level. I think there's very, very little chance that 148.90 is broken. I think as it gets there, we will do, we can finally do the trade that I wanted to do for a long time, but the market hasn't allowed me to do it, and I will naturally tweet it to you first thing on Monday. Thank you very much indeed, and have a wonderful weekend. Tweet you on Monday.